Welcome to another Straight Up Tuesday tip. I'm Tom Shallcross. With me, as always, is Mark Ainley. And with us for the first time in the underground, Chris Puleo. Chris, welcome to our Humble to Bold.
It's beautiful. Beautiful.
We'll get a window down here one day for someone.
The crazy thing is, this is the first time down here, and he literally has his office in this building.
Yeah. He said he went to the other basement. I was like, the other basement? What?
Yeah.
So, all right. So, a lot of talk about interest rates. It's been, a big talk for the last 2-3 years. We were talking off air, and you mentioned a few things of like, hey, like I actually think they're coming down. Here are some tangible reasons why. So, can you just set the table of what's going on, and we'll have some piggyback questions from there.
Absolutely. You've heard a lot of sales rhetoric about, rates are going to come down. Rates are going to come down by. Yeah, and because when rates do come down, things are going to get more expensive. Here's the reason why rates are going to come down. As you know, there's been a lot of political pressure on the Federal Reserve to start to lower the federal funds rate, which has a trickle-down economics effect on mortgage rates. Regardless of if the Fed chair decides to start cutting rates now or does not, there's only 6 months left of that term, and the Fed chair is going to get replaced by somebody who the administration wants, who has continued to push to lower interest rates.
Because Trump wants him out.
Trump
would
wants,
fire him today. If he
Trump, yes. It's ran independently of, obviously, the president, so the president just can't go in and fire the Fed chair, right? But the Fed doesn't have to reappoint the Fed chair once their term is up, okay? So we know in 6 months now that Fed chair is going to be gone, and the new one will be appointed by somebody that has the agenda of this office to lower interest rates. Because, as we've talked about many times, their goal is to lower taxes and raise more revenue, which creates more tax dollars to make up for the shortfall. The only way you can do that is to lower interest rates. So these past years, it was more market volatility. When are rates going to come down? How are we going to do this? The Fed keeps raising rates. Well, now we know at the end of this term that the person who the government wants in there to lower interest rates will be appointed.
In 6 months, if someone's listening to this 3 months from now, what's 6 months out? Are we looking at, is that the end of the year? Is that right in January?
They have to announce the new one, I believe, in January. I believe their term ends somewhere in mid-spring.
Okay.
But, it's sort of like a stock market thing, right? So as soon as the announcement happens, the market's going to start to shift before Powell even gets out. So what does that mean for your investor? Okay. If you wait right now to buy an investment property till rates come down, 6 months from now, 9 months from now, that same property you're looking at, it's going to be 10 to 15% more. That means your cash flow is not as good. Right now, if you buy that property 6-9 months from now, I can go in and refinance it at no cost, lower your rate down to market, and then your cash flow improves. And you're still buying it in at the lower price, gaining more equity once the rates do come down.
Yep. Real quick, you mentioned refi at no cost. Explain.
So what I've always done in my whole career, if you do your purchase with me, any refinance in the future, that's a rate and term refinance, as long as you qualify, obviously. I give a lender credit for any of the bank costs and title costs. I take less profit on refinances because it's important to me to keep my purchase clients happy, keep them in front of me, refer me out to other people, make my realtors happy, because just because you as an agent brings me a file today, my goal is to get you future referrals. And that happens a lot of times. Hey, I remember Mark referred me to you, and you've done such a great job for me. You keep saving me money. I'm going to call Mark, see maybe I can get another purchase. So I'm always trying to push that for the agent, but I also always want the client to be happy. I think that's why I've been in this 23 years. I've seen different markets. I've been able to survive the last 4 years. I've been able to survive 08. Because it's about treating people the right way and not trying to make every dollar and every transaction. And that's why I do a lot of volume, and that's the part I really enjoy.
23 years. How many companies? And I know that you guys had so many crazy mergers.
It was all mergers.
Yeah.
I was actually with this. I've been with only 3 groups in 23 years. But there was that time post 08 where it's like every 9 months I'd be coaching my kid on third base, I'd get a call and be like, "Hey, we just sold," and I'd be like, "Oh man."
The sign guy loves them.
So that's why I did change eventually my email and got my own email, because I'm like, I don't know who's going to sell tomorrow. But there's been a few now. There's been a few, but.
When I went to write down for the sponsor today, I had to think twice, and I still have your old first mortgage. First
mortgage was the brokerage I went to right out of college. After
I still
Wells
have
Fargo.
that pops up in my phone every time I go to email you.
Yeah, there's Waterstone, Republic, Academy, AMC, People's Home Equity. I mean, it's just. But again, I was with the same people. Just the name on the wall changed, but I was.
But he shares an office, so we see the guy come out and scrape the window every 6 months to put the new sign.
I got to the point where I didn't just tell Mark, I just changed the sign. You see it. But at the end of the day, I always say this: no matter what company any loan officer's with, you can be at a company. It's about your particular loan officer, their processing team, their underwriting team. Especially these days, nobody's reinventing the wheel. Okay, everyone has the same conforming products. Everyone has the same FHA products. It's the non-QM stuff that's maybe coming back that certain companies may have more than others. We're fortunate that we have anything and anything.
QM was QM.
What?
QM, what's that?
Non-QM. So what non-QM is think about the old days of stated income and that sort of thing. That is coming back, but not in an ugly sense. DSCR. Okay, so DSCR is a loan that is a perfect segue for investment clients, where it's a loan where if the rents cover the mortgage, you can get a loan with very little other qualifying. Okay, bank statement loans for self-employed. You literally go and give me 12 months of your business bank statements, and I qualify you off the deposits. You have $100,000 in deposits every month. Your income is $100,000. But what non-QM does is it's slightly higher in rate because it's higher risk. Some of them do have like a 2-year prepay, not all. And they are larger down payment requirements. Where we got into trouble was when you could do a stated income, interest only, no money down.
You get money back at closing.
Right.
Yeah,
like you bought a house to get money. Today it's so much different. It's how it was supposed to be. If you're self-employed, have good credit, and have a large down payment, you should be able to get a loan.
And to kind of keep on track for as far as interest rates go. So what I've been telling people right now is like the best thing about interest rates, even if you're wrong, right? You could be totally wrong, and Powell gets reelected. I don't know, whatever. But the best thing is right now is if you buy the property now, you're hedged against if it goes up. And then if it goes down, then you work with someone like you where you can refinance and you can get the benefits. So you can get the benefits of both sides right now. So that's why I'm sick of people saying, interest rates is killing me. I'm going to wait till they come down.
Well, the other thing too is like, you hear the other narrative, like historically, this isn't that bad.
No, it's not.
Right?
This is where I was at when I came into the game.
Figure it out.
Yeah.
Also with the appreciation of rents. Right.
Everyone only talks about my taxes are up, rates are up, but no one talks about that. That rent that was $2,500 is now $32. And if it's an 8-unit building, it's a big freaking difference.
It's rents are outpacing the rise of interest rates, and that's what investors I don't think understand.
I told someone the other day, People's Gas and Nicor, they're up like 120% per theorem, right. And you don't stop buying a property because your gas bill went up in your common area.
The other thing, being that this is a national, right? You guys reach people nationally. The one thing that's
international,
well, not only internationally, but nationally, this is what's different between 2008 and now. Each individual section of the country or state could be a completely different market, right? You're looking at Florida, where I do a lot of business. I have an office in Florida, where there's been 350% appreciation over the last 5 years. You had so many construction companies, so many different things. Where now their inventory is insane. In Lee County, there's 25,000 houses for sale. Think about that. So you're seeing a decrease in value in parts of Florida. What does that mean as an investor? Look for opportunity, okay? Because down there, you might be able to pick up an investment property at 30% less than it was 3 years from now. And as soon as rates go down, guess what's going to happen? All the people who want to buy second homes are going to go to Florida again, right? The second home interest rates are higher. They've been holding off. The people that want to retire and move to Florida are going to go back down there. Inventory is going to shrink down there. If you're looking for investment properties, look at each individual market. Here in Illinois, there's still limited supply, right? But there's opportunities still if you have the right agents, the right people. So know your market, know where you're looking to buy, and don't be so short-sighted because there's opportunities all over the country, and each market is very different.
Yep. All right. So one last question to try to gauge your confidence on this. What like $1,000 bet that rates will be lower in 7 months from now? Like how confident are you in this statement? I know nothing's for sure, but just trying to gauge.
95%.
Okay, so very confident.
Now rates will be less. If you would ask me that 12 months, I would have said 50%. In the next year. Our projections, economic projections, even outside of that, once even the economic data comes into play, inflation is down, right? So technically, rates should have already been lowered. If rates are not down, I would say they're going to be down. If I had to guess this again, I would be doing something different if I was always right on this. I would say by the end of the year, early spring, you're going to be looking at a 0.5% to 0.75% decrease. And I think as next year goes, you will be fluttering back to 6% by the end of next year into the high fives. I don't think long term you're going to really get back too close to 5%. I think you're going to stay between 5.5% and 6% long term, which is a very healthy market, healthy rate. I get asked all the time, are rates going to go back to 3%? You don't want that. Yeah. That means bad things are happening. It was a great run for mortgage people.
It might not ever happen again.
And honestly, you don't want it to happen.
Yeah.
But a healthy market is rates between 5% and 6%. And I think we will be there for sure within the next 12 months. I can see rates coming down 0.5% to 0.75% in the next 6 months.
All right. Good stuff. Ready to wrap?
Ready to wrap.
All right, who we playing? Chicago Fact, who we playing for?
All right, playing for Dan Redman. Dan, if myself or Chris gets this question right, you get a $50 gift card brought to you by Neighborhood Loans, the Puleo Group.
Thank you, Dan. All right, I know you're, when we were recording this, you got pads starting next week with your kids. It's football season.
Yeah,
we're here.
Football's in full go.
All right, so Chicago Bears question. Which one, I'm going to give you 4 statements. Which one of these is not true? The team was originally established as the Decatur Staleys. The Bears have the most total wins in NFL history. The Bears have the most members in the Pro Football Hall of Fame. The Bears have retired the most uniform numbers of any NFL franchise. 3 of those are true. Which one is not?
I think I know.
Which one are you picking?
I'm leaning towards the Bears do not have the most victories in NFL history because, and I should know this because my grandma was the secretary for George Hallis for 25 years.
There you go. I didn't know there's inside information here.
But I believe in the last 2 years they've been passed.
Wow. I know they're from downstate somewhere, but
they were from Decatur.
Oh, that's okay. Then
George Hallis played, coached, and owned the Decatur Staleys before moving it to Chicago.
What's the other 2 options?
The most members in the Pro Football Hall of Fame and the most retired uniform numbers of any NFL franchise.
I'll go with most in the Hall of Fame.
Man, Puleo all over it. Most total wins got passed up by the Packers.
Dude, we got a whole little lesson there too from you. Like, that's
huge. 2 things I know: mortgage knowledge and football knowledge.
All right, Dan Redmond, you win. Chris, thank you for getting that for Dan. So Dan, you get a $50 gift card brought to you by the Puleo Group, Neighborhood Loans. So, man, Chris, thank you for coming on. Tom, thank you as always. Listeners, reach out to us. We want to hear from you. We'd love to hear what you're up to. If you have a project you're working on, or if you think you might be a good guest, we'd love to hear from you. And again, Chris, thank you. Tom, thank you. And listeners, we'll see you Thursday.